and welcome everyone. I want to welcome you to this weekly market recap for Thursday, September 12th, 2024. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be here with all of you again this week. We've had kind of a wild week. I mean, we saw a lot of selling, and then here recently, in the last few days, we've seen a lot of bounce back. We've gotten some inflation news. It really wasn't that great. We had the August CPI report come out on Wednesday morning, and that showed that at the core level, we actually were a little bit higher than expected. And we had a similar report come out this morning. We had the August PPI report, and again, the core number came in just slightly above expectations. Both came in 0.3% rise when the market was expecting 0.2. What I can say is that I do think we're in a different position in a different market environment, because I don't think that that type of a miss in inflation a month or 2 months or 3 months ago would have ended very well. I think the market would have sold off big. In this case, it seems like it's just been a yawn. Market doesn't seem to care anymore about inflation. That's really what I've been saying of late. I don't think inflation is really the problem. I guess if we see that type of miss over the next couple of months and inflation starts to rise and starts to jump, maybe 0.4%, 1%, 0.5, and then obviously that might matter, and I think the market would adjust accordingly. But at least for this month, the market seemed to overlook the fact that the core PPI and CPI both came in above expectations. We had initial jobless claims. If you remember back about a month ago, initial jobless claims were starting to trend higher. And as a result, we had the unemployment rate starting to trend higher. Well, both of those have reversed. We got another initial jobless claims out this morning, and it came in right as expected. Last week's number really not adjusted. I think it may have been adjusted up 1,000 from maybe 227 to 228, something like that. But overall, the numbers are back down again. We saw in the last non-farm payrolls report, unemployment, after jumping from 4.1 to 4.3 in the month prior, in this last month, we came back down from 4.3 to 4.2. So some of the signs that were suggesting maybe that the economy was rolling over and maybe starting to weaken, which could lead to a recession, in more recent reports, we were actually seeing these go back to where they were. So there's still the possibility that the Fed, through all the rate hikes and stomping out inflation, could still see a soft landing. There's still the possibility out there. And personally, I believe even if we do have a recession, I think it's going to be a very mild one. That's just my opinion. And I believe that the start of the rate cuts, which is likely to begin next Wednesday with the next Fed meeting, I think that that's going to help spur the economy down the road. It'll take a little while for the effects to take hold, but I do think that the economy will strengthen in 2025, and the market tends to anticipate that. So right now, what we're sitting here looking at is a September-October period, which we know historically is not the best. We know we've got a presidential election coming up early November. The history of the stock market leading up to these presidential elections also tends to favor a weak September-October. So we've got some things that we're still going to be battling. And of course, every economic report's going to be scrutinized now that the Fed is turning its attention to maybe ramping up the labor market, trying to reduce the unemployment rate again and starting to focus more on the economy and less about inflation. Every economic report is going to be scrutinized. So I think we're going to see a rate cut next week. I'd be shocked if we didn't. Some are saying 25 basis points. Some are saying 50. I believe 25. I think that it would be sending a little bit of a strong message if we cut 50, like maybe the Fed thinks they're way behind the curve, and maybe they're already forecasting that the economy is going to weaken considerably. That's what the message would be, I think, if they cut 50. So I'm looking for 25. But I think even bigger than that, it's going to be what the Fed has to say as far as the number of rate cuts, what they're looking for, what's their language change to now? Are they now data dependent on all of these economic reports, not so much on the inflation side? Will they even talk about inflation? Will they say that they've conquered it? I don't know, but just beware that there's still a lot to get through. And again, the volatility that we've seen big drops, we've seen big rallies going back since middle part of July when we had that key CPI report come out, June CPI, which I think was released the morning of July 12th. So anyway, we're in the middle of this summer. I always tell our members, lower the bar of expectations in your trading account or in your investing during this period of time, because historically it is weak. And I've got some numbers for you I'll share with you in a few minutes. But let's take a look. Again, what I like to look at is what's happened over the last week and how are the various indices and the various sectors trading relative to one another. And what we had seen recently over the last several weeks is that there's been this movement away from technology, away from the Nasdaq, and we've seen more money rotating into value-oriented areas. Well, over this past week, we've had a little mixture of both. You can see these top two groups. We got technology, which all of a sudden has come to life. Let me give you an update as to where we are right now over the last week. Okay, 3.95%. So technology is up more than double any of the other 17 or other 16 areas that are on this list. So it's been all about technology, which is good in one sense. I mean, we needed a rebound. Technology has been getting hit pretty hard. So we're getting that rebound, but it's not like the other groups are jumping and extending their recent gains. So again, it's more rotation. We were rotating away from technology for a while. Now here more recently, we're starting to see a little bit more rotation into technology, but overall, no new highs. We saw just briefly a new all-time high in the Dow Jones a week or two ago, but that's, come back down. S&P 500's rising again with this strength in technology, but still probably needing a couple percent to get back to that all-time high. So we just haven't been able to make that move, and it's not unusual. This time of the year tends to favor the more value-oriented stocks that are not as heavily weighted in the S&P 500. And as a result, makes it very difficult to break to new highs. So I think we're going to have more of the same over the next 4 to 6 weeks. I would be surprised to see the S&P 500 break out to an all-time high over these next 4 to 6 weeks, even though we're not far from it. I do love the market long-term. I think we're going a lot higher in the fourth quarter and into 2025. But I think short-term, we've got challenges. That's why I'd be a little surprised in the near term to see it happen. If we flip to the bottom of the screen, you can see energy and financials. So again, we're talking about more value-oriented. Pretty easy to see why energy's been so weak. All you have to do is take a look at crude oil prices, which have now dropped down into the 60s per barrel, $60 per barrel. And that's the lowest level we've seen in quite some time. And there's strong positive correlation between the XLE and the direction of crude oil prices. So crude oil has been tumbling, and as a result, energy's been going down right with it. All right, let's move on. Talk a little bit about the Dow Jones. So over the last week, we can see the Dow Jones up a little bit more than 1%. We did go down, test the 20-week moving average, the rising 20-week moving average, which is above the 50-week. So there's still nothing technically broken here, but we still do have, some are going to look at this and say negative divergence. For me, I'm seeing now two highs with higher PPOs. So I don't think it's as clear that we're in that we have a negative divergence at this point. I think the Dow is trending above its 20-week moving average. And I think as long as we continue to do that, the index is fine. So that's what I would continue to look at here. Next chart I want to show you, the S&P 500. This negative divergence is still persisting. And in fact, if we break out again to another all-time high, it's only going to be worse. We're going to get our fourth top on the S&P 500 with lower PPO readings, or I guess third. We've had two lower PPO readings. So if we did it again, it would be our third. So at some point, I would be looking for a 50-period test, which we have not seen. And as you can see here, I've given you some numbers that we can zero in on here. But since 1950, the S&P 500 annualized return during the month of September can be broken down as I'm showing. From September 1st to September 16th, and today's the 12th, so we're almost through this period, but the September 1st to September 16th period, the S&P 500 historically has not done badly. If you think about the S&P going up 9% a year for the last, on average, for the last 75 years, we have an annualized return here in the first 16 days of September of 8.14%. So I'd say it's just kind of going along with what the S&P 500 normally does. It's the second half of the month that has historically been so weak. The 17th to the 30th, and let me just remind you that the 17th starts the Fed meeting next week. The 17th to the 30th, we have seen an annualized return. If we take all of those 17th to the 30th, going back 75 years, put all those days together, we have an annualized return of minus 26.77. And if we narrow that scope to the September 20th to 26th period, it's minus 44.06% annualized. That doesn't mean the S&P 500 is going to drop 44% in a week. That is not, it's annualized. So it's taking the losses that we typically see during the period, and then we're projecting it. So if you average, that if it was 52%, then you could say the average was the S&P went down 1% in that week, right? Because if your average is dropping 1% during a week and you annualize it, that 1% for 1 week would become 52% over 52 weeks. So don't read too much into this, but just understand that this is a very, very poor, bearish week. It's the second worst week of the year. The only week that's worse is in the month of October. And then the third worst week was the one back in July when the market topped. It was July 17th close to the 24th close. So it doesn't mean that we go down every week, every time September 20th to 26th. If we go up, please don't write in telling me that I don't know what I'm talking about. This is factual, and it's the history. It's the tendency. So it'd be no different than a football coach going into an NFL game and studying tendencies of the other team, realizing that whenever it's 2nd and 8, this is what they tend to do. Does that mean they're going to do it this upcoming Sunday when we play? No, it's a tendency. Just take it for what it is. These are tendencies, but the second half of September historically has been much, much worse than the first half. Keep moving on here. Another chart here on the Nasdaq. Basically same thing. We still got negative divergence, although we did get a 50-period test back early in August when we had that August 5th drop. That went almost all the way back down to the 50-week moving average. So, and what I look for after negative divergences are either, or maybe both, a weekly PMO test, a centerline test, which we haven't gotten. That's why I got these pink arrows, and or a 50-week SMA test. And we have gotten one of those, or right down close to it. So the divergence at this point in my mind is kind of a little blurry. Is there a negative divergence? Isn't there a negative divergence? But as the PPO gets closer and closer to zero, at that point, the PPO resets. And as far as I'm concerned, negative divergence is over. Now, looking at the numbers that I just gave you on the S&P, how does it compare on the NASDAQ? 1st to the 16th, up 6%. 17th to the 30th, minus 31%. These are annualized returns again. September 20th to the 26th, minus 52%. Now, these are readings that go back to 1971 when the NASDAQ first came about. So we're talking about the last 43 years or so. Last one I want to talk about here is the Russell 2000. Since 1987, the Russell 2000 annualized return broken down the same way. The 1st to the 16th, plus 25.61%. 17th to the 30th, minus 39.73%. And the 20th to the 26th, minus 83.88%. So that is a pretty significant drop off from the 20th to the 26th. Keeping all this in mind, again, just giving you a point of reference in terms of history of what we can expect or what we have, produced in prior years, just so you have an idea going into the second half of the month. History, seasonality is not my number one indicator. It's always the chart. It's always price volume. That combination is my number one indicator by far. Everything else I always talk about, they're all secondary indicators. So, for instance, the IWM is trending up. The 20-week moving average is above the 50-week. We're currently, this week, we got a hammer printing right on the 20-week moving average. Price action to me looks pretty good. It's just being aware that things could fall apart so that I can prepare for it one way or the other. That's the whole idea behind using secondary indicators. All right, moving on, I want to talk about the VIX. So the VIX, we saw the VIX, spike up above the 20 level twice. We got up to 65 in early August. More recently, 23, 24. But we are back down, and we're down around 18 right now. The VIX has a history of going up during the months of August and September. This is the time of the year. I mean, if you look back last year, here's September. We started September pretty low, but look at what September did. Went right up. The year before, look at what happened. Started mid-August. We rose through the end of September. The prior year, you can see that big spike and jump in September, and then we actually came down. That was in 2021. We actually came down during the month of October. But we can just look at the recent years and see that the VIX typically spikes this time of the year. The market is nervous. That's the way I look at it. The market is nervous. It's not going to handle bad news well. And it might even interpret good news to be bad news sometimes. So we've got 4 to 6 weeks left of what I think could be a bearish period. I'm not saying we have to go lower. Long term, I think there's a lot more room for upside than downside. But in the short term, I do think that there's a reasonable possibility that we could go back down maybe as low as the August low. Maybe we go a little bit below it, but if we do, I think it'll be very short-lived, and I think we'll bounce back up. That's my feeling at this point. 10-year Treasury yield, just want to mention that this trend, which had been going up, if you look at the RSI, and this is on a weekly chart going back the last 2 years, when the RSI, the weekly RSI remains at 40 or above, you're generally in an uptrend. When you see a trend line give way and you see the RSI break down below 40, then you should be anticipating that you are trending lower. That's exactly what we're doing. That's what this chart's telling us. So we're clearly in a downtrend right now on the 10-year Treasury yield. And given the fact that the Fed is getting ready to start cutting rates, I would suspect that while we might bounce and hit that falling 20-period moving average from time to time, I would suspect that we are going to remain in this downtrend. All right, technology. I just wanted to show you technology. We were going up. We had a negative divergence. Again, this is a 5-year weekly chart. And what we might be doing here is maybe some symmetrical triangle formation. We got a lower high. So far, we got a higher low. And so maybe we squeeze over the course of the next 4-6 weeks, maybe within this triangle. Possibly we go back down and test this neckline. I mean, if we really want to spook folks, we go below the August low. And then I think that's when you might see the VIX spike and have a really quick drop, more of an impulsive drop to the downside, where I could see us possibly on the S&P 500 going below 5,000. But I think it would be a very quick move to the downside. Semiconductors, just wanted to point out here, nice bounce back week here, up 12% this week. So this is a very volatile group. We had a lot of selling the prior 2 weeks. But this last week, you can see we are bouncing back nicely, which is good news. Not out of the woods. We still got clear resistance that we're going to have to get through. But at least it's a start. It's a little bit of a rebound. It's a little bit of relief for the folks that have been watching this group fall for so long. Last thing I want to mention here is on energy. Energy, the XLE has been going up for quite a while, but we have rolled over. And you can see the price action right now, which is down right around that 85 level, is the lowest that we have seen since probably about 7-8 months ago. And you can also see from a longer term perspective, we are now testing weekly RSI support right around 40. So if you're maybe a little bit more value oriented, you might like this pullback and say, hey, I want to go ahead and jump in. I would just simply caution that we do have some other support levels that we should be paying attention to. So we're not completely out of the woods, but if you do like to follow the RSI, maybe we get at least a short-term bounce from here. All right, I want to point out over at our website, EarningsBeats.com, you can see, if you go over to EarningsBeats.com, you can sign up for our free no-cost 30-day trial to our paid service. I'd love to have you and check it out, kick the tires. If you don't like it, simply cancel within the first 30 days. But I also have a free newsletter, and I want to point that out because there's no credit card required. You can unsubscribe at any time. And I do try to give back to the community, give some of the thoughts and processes that we go through in trading, share individual stock charts, share sectors, industry groups, sometimes talk about sentiment, all the things that are important to us. at EarningsBeats. So if you sign up, I think it'll help. That newsletter is distributed. It's not really a newsletter. It's a 2-paragraph, 1 chart, kind of an article that comes out twice a week, Mondays and Wednesdays. Now, if you are on your mobile device, make sure that you click on the QR code that's on your screen, scan that QR code, and that will take you to a page where you can sign up. So just making it easier for those of you on a mobile device. All right, let's keep moving because I got some more I want to talk about. I want to go through the Mag 7 plus one. I got an 8 stock that I like to follow as well, in addition to the Mag 7 that I think kind of a cult stock like the Mag 7. Anyway, all I have up here right now is a daily chart, and you're going to see obviously some weakness because the market's been weak. But one of the things I want to focus on is the AD line, and one other thing is the relative strength. So Microsoft trying to get through its 50-day moving average, AD line's been good. So I think long-term Microsoft's going to be fine. Short-term, there is a lot of movement to the downside in the relative strength. So while Microsoft is maybe just consolidating for a while, you can kind of see left shoulder, neckline, head, neckline, right shoulder, still messing around near the right shoulder. Do we come back down and test that level? I don't know. But over the last 2 or 3 months, Microsoft has lost a lot of relative strength versus its software peers. So in other words, there are a lot of other software companies right now that are doing better than Microsoft. Apple tried to get back up to its high that it saw in July, failed, started to roll back over. It's currently trading below both moving averages. I think just going sideways. AD line, maybe a little more iffy, but relative strength is very strong here. So Apple continues to outperform its peers, which is a good thing. Nvidia making a nice run. Just last week, remember I was talking about Nvidia taking a big hit, the possibility of Nvidia even going to 50, even though I think that's a little bit of a stretch. I do think getting back down to August low is a possibility. And if it breaks that, I could see 75, which would be closer to what we saw back in April. But after this week, obviously, the back and forth volatility, I think it's going to continue. And I do like the AD line, and I do like Nvidia's relative strength. So even if some semiconductors sell off like they have, Nvidia is outperforming the group as a whole. So we still have a really good leader here in Nvidia. I love this stock for the long term. It's only the short term, if the market sells off, that I'm a little bit worried about it. Meta Platforms got double top right here, up just above 540. After testing that level in mid-August, we've kind of bounced back down. Now we're trying to make another rally attempt. Got to get through about 540 to 542, somewhere in that area, to really make a more meaningful breakout, maybe even a little bit higher than that, maybe 544 back that high in early July. So I like it. AD lines come down, but Meta remains a pretty strong relative performer versus the internet space. Amazon starting to strengthen, or continuing to strengthen off of that August low, now taking out that temporary high that we saw in middle part of August. We broke out above the 50-day moving average yesterday. We're trying to tack on, but we are at a key gap resistance area on the chart. AD line looks great. Relative strength, starting to strengthen a little bit the last couple of weeks, but this hasn't been good. So if the market turns back and rolls over again, I don't think Amazon's going to be immune to that weakness. Google has been one of the worst performers, in my opinion, as we keep setting new lows. So we went below that August low. Not too many stocks have. We've had a really nice rally off of that August low period. But Google, you wouldn't know it from looking at the chart. Failure to get through the 20-day moving average. I think this is a problem for the stock. AD line's been going down with price, and look at the relative strength. We're much closer to a 52-week relative low than to a 52-week relative high. I think Google is one of the weakest right now of the Mag 7. Tesla's been strengthening. You can see a nice little uptrend here over the past 5 weeks or so. AD line trying to turn back up again. I'd like to see that break back up above the mid-August high. Relative strength not far from where we were back in mid-July. So I think the strength in Tesla here is maybe kind of masked a little bit. I actually think Tesla might be a little stronger than what its chart is showing, but we still got to clear some key levels. Big gap resistance up just below 240. You can see now the double top that comes in the mid-230s. We've got to get through those levels before Tesla, in my opinion, can make that next move. Netflix still hovering, not far from breakout level. We saw kind of a cup maybe a handle back down to the 20-day, starting to turn up again. The AD line, not great, but the relative strength, really good. This is one of the better stocks in the internet space right now. So keep an eye on Netflix. Costco, this is the added one. I just think Costco is kind of in a cult of its own now. It's up near an all-time high again. So we've got an uptrend followed by a nice little cup. I would expect a little pullback before a breakout, but this one, AD line strong, relative strength off the chart strong. Costco remains one of the best charts in the market, in my opinion. All right, I want to finish with looking at a chart and a company and how you can maybe find a long-term company that you might be interested in. And I'm looking at this from an income-oriented investor, not a growth-oriented investor. So that's kind of going opposite of what we do at EarningsBeats. We're mostly momentum investors, but we are looking at having a separate service that talks more about finding the right stocks for a long-term portfolio that generates a nice income and also gives you some growth potential as well. And so I wanted to start off with a chart that I like, and I'll just kind of explain a little bit of why I like it. This is Robert Half International. And if you look at it over the last 2.5 years, it hasn't performed well. And if you go back in its history, it's gone through some periods before where it's gone a couple of years. Financial crisis was one where we went down for 2 straight years. But I've also marked whenever the monthly RSI dips down to 40 or below, even down to 30. And that's this green shaded area. And every time it goes down and bottoms, you can see I've got a black dotted vertical line. And so buying from a long-term perspective, when a stock that's had a pretty good run over a long period of time, when you do get pullbacks, they tend to be great times to enter. And so that's all these vertical black dotted lines are looking at. They're just highlighting when you would be getting in if you got in at or near a monthly RSI low. And for the most part, these are pretty good entry points. And so all I'm doing is pointing out that we're there again. Right now, we have a monthly RSI at 39. And if you look back, there have been few times in the company's history going back 32 years, 32 years. There's been a few times where we've seen the monthly RSI go down below that. So we have a long-term uptrending stock, which I really like to see for any company that I want to hold long-term. It seems to make it through all market environments. And then I want to show you the dividend history. This is at Nasdaq.com. And then you just find the dividend history and you can come in and you can look at any stock. But look at the dividends. Right now, Robert Half is paying 53 cents a quarter. Last year, it was 48 cents a quarter. Before that was 43 cents a quarter. Then it was 38, 34, 31, 28, 24, 22, 20, 18, 16, 15, 14, 13, 12, 11, 10, 8, 7, 6. We go all the way back to 2004. Every year they've raised dividends. And on average, if I had to average it all out, they've probably averaged raising their dividend more than 10% a year over 20 years. That's what you want to get. You want to get a company that has a great long-term track record, maybe has pulled back a little bit. That gives you the current higher yield, which right now on this stock is a nice 3.41%. But on the money you invest today, those dividends historically have gone up 10% a year. So your dividend yield next year on that money invested today would maybe be 3.7%. The following year would be 4%. Why is that important? Well, you want dividends to grow. You want consistency of dividends and consistency of dividend growth because you're going to deal with inflation as you go into retirement and so forth. And so you want to build a portfolio of stocks that not only are reliable or have been consistently reliable about paying you dividends, but also consistently reliable about raising dividends and raising them by a considerable margin. So everything that we've been through over the last 20 years, the secular bear market, the financial crisis, the 2015 correction that we had, the 2018 trade war, the 2020 pandemic, the 2022 cyclical bear market, everything. Robert Half's been a company that has continually moved higher and higher, higher highs, higher lows, over 32 years, has paid dividends now, according to this website, for the last 20 years, and has raised dividends every year to the tune of about 10% a year. Anyway, those are the types of things that I would be looking for in a company that I would want to own longer term. So we're going to be looking at this. If you do join us over at our EB Digest, the free newsletter that we have, I'm going to be talking about this from time to time as well, introducing the folks, our community, to a service that we're going to be lining up for later this year. So make sure you sign up for our EarningsBeats Digest. And if you want to follow me at EarningsBeats, you can see now another QR code that you can follow. Simply scan that code on there, and that'll take you to a page where you can learn all the different places that you can follow me, social media and so forth, YouTube. But please check that out. All right, it's been a pleasure again to do this. We've got a lot of things that we're watching as we roll through September and October. I wish I had the crystal ball that could tell you every single up and down movement during this period. Unfortunately, I'm not that good. And I'll tell you, I'm not that good. The shorter that you look at on the market, the much, much harder it is to try to figure out the next move of stocks. I mean, you can come up with some, positive divergences or negative divergences on shorter charts, like hourly charts, that could give you some clues. You can look at the put call ratio. I like to look at that to kind of give me clues about reversals. Of course, candlesticks themselves, hammers, bullish engulfing candles, all of that can tell you. But it's still especially in September and October, very, very volatile period. Last, 3 or 4 days ago, looked like the market was going to go straight down. And all of a sudden, out of the blue, we had this massive rally. Really, over the last 24 to 48 hours, we seen such a big reversal. I wouldn't be surprised if we see something like that next week when we've got the Fed and everything else, where we see another big move, potentially to the downside. Anyway, it's just hard out there. I feel for everybody. But remember, just got to get a bridge to get through this period. And then I think we're going to see a much stronger market into year end. Have a great day, great week, everybody, and I'll see you next week. Happy trading.